All right, and we are live. Hello, everyone, and welcome to the another episode of the Big Whales now rebranded market call called Future Finance. Today, we are going to discuss one of the topics and one of the trends that took the digital asset market by storm in the recent period, real world assets, but more specifically, a market segment of the real world assets, tokenized equities, which I looked forward to the most when I started researching crypto 4 years ago. For you who don't know me, my name is Aleksandar. I'm a lead research analyst at the Big Whale, the host of the Future of Finance, and today I'm joined by two guests, two experts in the field: Oya from Ondo Finance, EMEA director, and Marek from X, managing director of global markets. Folks, welcome to the show.
Thank you for having me.
Yeah. Of course, it's a pleasure. As I mentioned, so the market took the real world asset segment took the digital asset market by storm. Right now, I think total valuation of the tokenized assets across many different sectors is more than 30 billion. But today we're gonna discuss tokenized equities. So my first question for you, Oya, is what are the key drivers that are actually driving the shift and that are contributing to this such tremendous growth of tokenized equities? Yeah, so sorry guys for this. We are back. I hope you can hear Oya now. So my question was, what are the key drivers that are led to such success and rise in tokenized equities? Oya, the stage is yours.
Yeah, hope you can hear me now. Good. Okay. So at least from our journey at Ondo, we started with tokenized treasuries, and now we can see the market is shifting to focus on tokenized equities. And I think what's driving this shift is mostly macro environment plus the maturity of the infrastructure kind of coming at the same moment. So the tokenized treasuries were kind of the proof of concept. These instruments demonstrated that we could have institutional grade assets on public blockchains with proper compliance, with instant or near instant settlement, 24/7 liquidity. So this kind of proved that the rails work. But now there's a structural pull towards equities and other kind of liquid financial instruments. Obviously, rate cuts are a factor. They're compressing treasury yields and people are looking elsewhere for yields. We've moved from 5+% to now 3.5, 3.75. And when the yield phase, the value proposition has to shift to access and efficiency, which is exactly what tokenized equities deliver. So for our own progression, we went from tokenized treasuries to tokenized stocks and ETFs. And the next stage, which I'll talk about a little bit later, is launching of more derivatives like perps. And this follows a deliberate logic where each product layer unlocks the next user profile.
Yes. So you would say that key drivers are 24/7 availability, then liquidity, right? Ample liquidity, and also demand pressure from the market. Do you see that at Ondo? Actually, clients coming to you and demanding these products?
Yeah, definitely. I think one that you didn't mention was access. So in some regions of the world, it's not easy to access US markets, for example. That's one thing that we've enabled with our global markets platform, which gives easy and efficient access to US listed markets in regions where it previously wasn't possible.
Yeah, perfect. Now that you mentioned access, it's actually quite useful for me in Serbia to access US equities because I can't, it's very hard for me to set up a brokerage account on Interactive Brokers. I am not allowed to use Robinhood or Revolut, so this makes a perfect substitute for that. We talked, you mentioned briefly US Treasuries and we have tokenized equities. Which asset class do you think will dominate the most when it comes to value demand going into in the second half of this decade?
I think we will continue to see growth in both of those. Proper financial institutions move on chain, which they really haven't yet. I think we will see hockey stick growth in treasuries and equities. Right now, the infrastructure isn't there. But I think for the already on-chain investor base, the next asset class, which I'm quite excited about, is going to be derivatives on these tokenized stocks and ETFs. So I mentioned perps, but also other structured products. I think these will open up a lot of exciting opportunities for buy-side and institutional participants. And we're going to see a true migration to on-chain multi-collateral asset management.
Yes, brilliant. Marek, so we have seen the expansion of non-native assets on chains in tokenized real world assets. So, and you at 21X, you started at Polygon, if I'm not mistaken. Now you integrate with Stellar. So, which public, let's say, let's frame the question like this: which public or private blockchain right now, currently on the market, fits the need for tokenization?
So I think between the two types, we obviously at 21X, we firmly believe that public chains are going to play a major role. It's because they offer what the permissioned chains do not have, which often exists as walled gardens for specific use cases, specific purposes. We do believe that different asset classes will live on different chains, sometimes on multiple chains. We do believe that the truly global capital markets can only exist when a majority of the assets will be on public chains, and this is how we build our infrastructure. It doesn't mean that we are not thinking about the specific use cases where the permission chains will still play a role. But obviously our current view is to go for the public chains.
Perfect. Yeah. We at Big Whale, we are constantly talking to institutions, and everyone is just saying to us like public blockchain, public blockchain, public blockchain, like private. If you're working with private, like leave me out of it, please. But yeah, that's kind of the narrative and that's shaping right now. To that point, I would like to ask you, so how do you approach the due diligence when you decide on which chain to utilize, and what are the, let's say, 2 or 3 key fundamentals that you look at when deciding which rails to implement on?
So I think the major factor or 2 major factors in the first place are what are the volumes on the particular chain and how often it is used in actual use cases that relate to our business model. That also includes and kind of is directly related to the type and attractiveness of the assets that are issued on particular chain. And I think it's also fair to say that some chains are easier to integrate than others, like in EVM compatible chains from our perspective are slightly easier to integrate and to add to our platform than other types. So that's how we look at it. And given that we talk about the equities and other more liquid assets, I think the performance will also play and is playing a major role going forward. So whether that's digital twins or native equities, for example, the latency, the throughput of the particular public chains will be something that we pay special attention to.
How do you approach the security question of, for example, the track record, hacks, outages when it comes to blockchains? How do you evaluate that?
I think it's a lot to what Oya mentioned at the beginning, is how we built the institutional grade security and infrastructure around those chains, and how we cover the elements of the infrastructure which are the most exposed. We obviously, as 21X, we are highly regulated in Europe by BaFin and ESMA. We go into US as well, and we pay special attention to that and not to expose ourselves and our clients. We also, in our case, we are not a custodial exchange, so that's slightly different case. But this is a very relevant question.
So you worry primarily about execution and the actual throughput that this chain can handle.
Yes.
So you can match the order book
But
that you offer.
Our clients work with best in class custody providers, both on self custody basis or with licensed custodians, and I think again part of the adoption is for those players who are not only coming from the more crypto or DeFi space, but also traditional, to get fully comfortable with the security aspect of using in this particular case public blockchains for transactions.
I see. Perfect. And now you mentioned infrastructure, and I wanna switch the discussion to mechanics that are happening in the background. Yeah. So Ben, before I do that, I want to remind our audience, dear audience, to ask questions, and they'll be gonna be directed to you guys during the discussion, and also a 15-minute at the end for our Q&A block. So you at 21X, so you are the first EU-regulated DLT exchange, and you offer something called atomic settlement.
Mm-hmm.
Can you elaborate on this, and what does it change for institutional workflows?
I mean, fundamentally, atomic settlement means that from the traditional value chain, we remove completely the stage which is called clearing. So there is the way we design our smart contracts is that there is no counterparty risk and no settlement failure. So that is part of that is a feature that is no longer an issue. It does change to an extent the way market participants trade, how the order book is being built. In our case, is central limit order book, fully deployed in smart contract on public blockchain. It will change in the future how market makers interact with exchanges. At the same time, the atomic settlement allows things like instant collateral mobility, so much better capital efficiency for a number of use cases, which generally removes a lot of risk and shortens the time required to actually make the match and trade and settle the transaction.
Yeah. So speed, essentially.
Yeah.
Perfect. Oya, I'm interested in knowing, how does the custody and settlement model work for tokenized stocks at Ondo?
Yeah. So the tokens themselves are held on chain by the end investors in their own wallets. Right now, we're supported on Ethereum, Solana, and BNB. So any compatible chain on any three of those chains would work. The underlying securities, which are the collateral for the tokenized stocks, are held off-chain at our SEC-regulated broker-dealer's custodian. In terms of the settlement, the minting of a tokenized stock by an eligible stablecoin is instant. Actual transaction, which backs the minting of a tokenized stock, the transaction of the underlying in the underlying stock market, is subject to normal market times. But we handle that ourselves, and the end investor will have the instant mint redeem feature. And then we go and trade the underlying stock in the stock market, which will always be subject to, for now at least, the traditional capital markets hours.
Perfect. Yeah. 24/5 trading, right?
Yeah,
0.5 trading. I have another question for you, actually, from our audience. Is from Hugo. So, what is for now the composability of the tokenized assets, for example, money markets, etc.?
Yeah, so our tokens are freely transferable in the secondary market and usable in DeFi. We've done some work with some lending protocols where they can be used as collateral or borrowed against. The money market funds and treasuries fit this use case more naturally, so they can be used on some exchanges as collateral to replace kind of stable coins or idle cash you might have in the account.
And what would be a next step on this regard, like having real world assets on chain? But it is upsetting that sometimes you cannot find the use case outside of that. You just tokenize assets and that's it. So what are the next steps to boost adoption even more?
It is upsetting, I agree, but I think we take things one step at a time. So similar to what I said about treasuries being a proof of concept, now we have tokenized equities on chain. And that's great, but that gets boring really quickly. Okay, I have an ETF, but if I can't use that anywhere, what's that good for? So that's the next stage that we're working on, where you might, again, borrow against it, or you might use it to get extra yield somewhere else, especially for an on-chain user base. They don't like just holding on to stuff, even if it's Bitcoin, right? That's why the whole Bitcoin Fi thing was born. And yeah, I think the tokenization is done. We've proved that it works. Adding utility to these assets is the next big step.
Okay. There is one interesting question as well. Right now, they are just flooding the chat from G. So he's also directing a question for you, Oya. So do you see any assets being tokenized using the STO model, or have they all shifted towards a tokenized fund, DF structure? Are there any signs of it shifting back to STO?
I think on our side, we're pretty confident that this model works, proved that it works. So we launched in September. In 6 months, we've reached 800 million in TVL, almost 18 billion in trade volume. I think there's benefits to both, and it doesn't have to be shifting back or one or the other. You can have multiple versions of these, like how, there's this whole debate about native on-chain assets versus tokenized, which is a wrapper. And both of them work. Both of them serve different purposes. And I think these can coexist.
Perfect. Yeah, it massive flexibility. Why choose one over the another when you can utilize both? Marek, there is also a question for you. So who is actually positioned to provide continuous quality monitoring of the underlying internal to platforms like 21x or Ondo, or do you see room for independent infra for that?
Quality of that, just not sure I understand the
quality monitoring of the underlying assets, so that they're actually deposited.
I mean, in case of, for example, the assets like the Ondo global market offering from Oya's company, as she mentioned, they sit, the underlying asset sits eventually on the CSD where the native stock is issued. I think in the future there is obviously opportunity that the equities, for example, themselves will be fully native at the CSD level. We know in US there is a big effort being done to go into this direction. The question is there going to be an independent infrastructure for that? I think some of the traditional finance or legacy infrastructure will convert to provide this assurance, and some will not, and will be kind of eventually, I don't want to use the word fade away because probably that's not going to be the case, but will struggle to exist in the new capital markets.
Okay, I see. All right. And one last question before we progress to another section of discussion, which is the European outlook and kind of the outlook of the entire market, which is I would say the juiciest one. But do you handle the register, Market 21x, and how to reverse an order if the custodian or administrator deems the trade unacceptable? Question from Andrea.
So, I mean, it's a bit more complex issue because obviously we are obliged from the regulatory perspective to ensure finality of the exchange. Delivery versus payment, asset versus stablecoin is a fundamental aspect of the way this infrastructure. So the reversal of trades is a I don't want to go into technical specifics, but it's a bit more complex aspect under the new setup, so to say.
Okay, perfect. I hope, Andrea, that answers your question. So we're going to progress to, European outlook. And now that Europe is becoming a strategic market for Ondo, what are the real barriers for institutional adoption here in comparison to, let's say, US?
Yeah, I think on the barriers, Europe is genuinely strategic for us. We've announced a partnership with BX Digital, which is a subsidiary of Börse Stuttgart, and 360X, which is associated with Deutsche Börse. So a lot of these traditional financial regulated exchanges are coming on chain, and we have more similar deals in the pipeline. We also had a base prospectus approved in the EU, which was a significant milestone for this market, and it opened up regulated pathways for distribution of our tokenized stocks. I think the two barriers that remain, or the top two, there's a lot more, a long list of barriers, but I think the two that I have at the top of my head is, one is the regulatory separation. So MiCA covers crypto assets, but tokenized equities now very clearly sit within MiFID territory. And institutions want one clear answer, not two overlapping frameworks. And second, I think, is the custody infrastructure. So European custodians are not yet fully equipped to hold tokenized securities under their existing standard prime brokerage agreements. Until a major European CSD or a custodian bank offers this as a standard product, institutional scale will always be constrained.
I see. Do you think that this, the tokenization way in the Europe will open gateways for capital to flood into the European financial ecosystem, especially to publicly traded companies? If we pull up the data, we can see that Europe's stock market is, I don't know how many times smaller than US stock market. Can that be a gateway for this capital that bypass Europe until now? And will it be easier for allocators to invest in European financial ecosystem?
Yeah, I think globally it's just a fact of the markets that the US capital markets get more demand, especially countries that are more emerging economies tend to flood to US markets or commodities as the most natural first investments. But I think on capital flows, the near-term reality is inbound. So European retail and institutional investors gaining easy and efficient access to US equities without a traditional brokerage account. Europe, this has kind of been solved for. But if you go a little bit outside of developed Europe, then it's not that easy. But I think the more medium to longer term opportunity is more two-directional. So European mid-cap companies today, for example, are largely invisible to investors outside the US. So you could be an Asian family office, you could be sovereign wealth fund in the Middle East, and they route capital primarily to the US. Tokenization kind of removes that, and you could be a European SME in tokenized capital from different parts of the world. That kind of capital inflow, tokenization could open up that kind of capital inflow. And the EU DLT pilot regime is that kind of sandbox where that infrastructure gets built.
Yes, nice that you mentioned the DLT pilot regime. I hope that more glorious days will return to Europe, the financial markets in the future, and the tokenization will be at the forefront of it. Marek, is the EU's DLT pilot regime fit for purpose, or is Europe at risk for failing behind the US?
That's a very, very good question. I think timely question. I think we all do realize that US is picked up the speed significantly in the last year and a half, and the openness from the regulator is quite pronounced there. You ask about the how fit the DLT pilot regime is.
Yes,
I think from the perspective of the business that has the so-called TSS DLT TSS license under this regime, we see certain limitations provided by the current regulation, which would have to be lifted, and ideally the sooner the better, in order for us to be able to take the full advantage of our infrastructure that we already built and the process that we have. I think I wouldn't be the only one to voice that opinion. There is an industry-wide initiative among our colleagues, peers in the European market called a quick fix. And also an effort with letters being shared and lobbying with European Commission and ESMA and regulators in general to make DLT pilot regime more open and giving a bit more freedom in terms of what the players regulated by this scheme can and cannot do.
You named a few limitations. Can you tell us what are these? Can you name like the most important or let's say the biggest limitations?
Yeah. I mean, I can mention two examples. So one example is we have quite strict limits in terms of the type of products we can list on our platform. So, for example, so-called complex products, which frankly the technology is very well designed to handle those complex products, because we're talking about the asset pools, assets with products with certain derivative components, which can be very much automatized with smart contracts and DLT. We are very limited to list them on our platform at the moment under current setup. We hope that is going to change. The second aspect is also, for example, for equities, there are market cap limits in terms of the assets we can put on the platform, which, even if we would have a very interesting company that wants to list, but sizable, we would be, again, at the moment, prevented from doing so by the regulatory regime.
Okay, all right. So that needs to be changed quickly in order for business to scale. Yeah, we heard Marek's examples of the greatest limitations. I want to ask you, what is a single regulatory clarification or change would remove these biggest frictions for institutional scale in Europe?
Yeah, I think it's always hard to single out one thing because there's so many moving pieces and so many different regulatory bodies and counterparties at play. But from my point of view, I think if we had a clear ESMA ruling on whether tokenized securities qualify as equivalent to CSDR regulated book entry holdings. So you have a tokenized asset via a smart contract. Does that satisfy the same prudential and regulatory treatment as holding it through a traditional CSD? think that ambiguity alone is sufficient for most TradFi companies to not even consider entering the space. It's going to be one of their first questions in their DD. And you could have, it doesn't need to be new legislation. It could be an action letter or an ESMA Q&A that clarifies the settlement equivalence under CSDR or something like that. So it doesn't need to be, necessarily a huge undertaking, but still it feels like we're a while away from that.
Yes. Okay. So we have an interesting question from Selena. So she asks, do you see a beefification happening where the retail grade RWAs, so real estate and other assets, sorry, I lost question. Yeah, real estate and other assets that are being developed on a separate infrastructure from institutional rails, or will the same custody models, clients frameworks, and settlement layers eventually serve both retail and institutions? And which come first?
Maybe I can
go ahead, Mark.
This question to some extent. So interestingly, for example, our platform technically and regulatory wise would allow retail customers to participate directly without the broker. The question is always whether the exchange like ourselves and any other exchange is able to handle the retail flow directly without the intermediary. And I think this is the operational model. The questions about the operational model really lies. Do I think that can be fully joined up? I think it's operationally quite difficult. It's technically possible.
Okay. So you would say that technically possible for both venues, so for both rails to exist on the same framework, or
the retail clients
separated?
Trading directly on the same infrastructure without the intermediary against institutional clients, yes. Is it operationally valid and possible? Probably as of today, I wouldn't bet all my money on it, but technically it would be possible.
It would be possible. Nice. I have last question from my side, directed at both of you. So before we jump into Q&A block. So we've seen this huge 2 blocks from US, so across the pond. We have on the one side Kraken NASDAQ partnership, and on the other hand, we have ICE, OKX, and Securitize going, the infrastructure, developing infrastructure rails for institutions to tokenized equities. Where does the real institutional moat lie? I'll start with you, Oya.
Yeah, I think the exchange route is betting the moat lies in legal certainty and clarity and trust in the issuer. If tokenized shares carry the same governance rights as traditional shares settled through DTCC, then they become indistinguishable to regulators and institutional companies and institutional compliance within the companies. The infrastructure route is betting that the moat is with the transfer agent and distribution layer, so control of ownership record, corporate actions, and the minting logic. And that's kind of what connects the capital markets. So if you own that layer, then you can extract value from every tokenized issuance, regardless of where it trades on. I would say our view at Ondo is distribution plus liquidity, and that sits between them. And that's really what we've built at Ondo with Ondo Global Markets.
Perfect. Marek, do you have to add something?
I think the jury is still out.
Okay.
On that topic, I think, I wouldn't underestimate also mentioned what DTCC is doing with their launchpad. I think it's also a slightly different take to what NASDAQ and New York Stock Exchange are doing. So as I said, I think the jury is out.
Okay, perfect. Politically correct answer from your side. All right, we have a couple more interesting questions. So first one is from Patrick, and he directed it to both of you. So please provide your insights on that. So on the liquidity side, for tokenized equities to reach institutional scale, you need either a single dominant venue or interoperability between MTFs. It's his take. Which scenario do you bet on for 2027, 2028? Single winner or fragmented but interoperable? Let's start with you, Marek.
For natively issued equities, I think probably a single big CSD that is going to be willing to go all the way to bet on tokenization, and what Oya mentioned, make the tokenized asset to an extent an equivalent to traditional ones available. I think this is probably what gonna maybe not make the whole change, but will trigger a lot of the adoption. because that would mean the whole ecosystem will have to adjust to that around that specific party. And I think this could be a triggering point for tokenized equities overall. That would be my view as of today.
Oh yeah, what's your take? Single winner or fragmented but interoperable?
I mean, fragmented but interoperable is wordier, but I think I'd go for that because it seems to fit more with European market structure as it currently is. And I think it's not just interoperability cross chains, but also interoperability and fungibility of these instruments with the non-tokenized versions of these.
Don't you think that interoperability sometimes presents a weakness, and because not for interoperability, sorry, fragmentation presents the weakness in the digital asset market, that a lot of chains that are essentially zombies get, trap the liquidity and capital on their rails.
Yeah, I think we're seeing less new chains launch, or, they're more networks rather than full-on layer one blockchains. I think the fragmented liquidity issue was already an issue with crypto assets, but now with tokenized stocks, so we are supported on 3 chains and we have easy solutions between those 3 chains. But then, it's going to come to a stage where the end investor doesn't know or care if they hold a tokenized Tesla on Ethereum or BNB or Solana. And, they're going to try to use it in one place versus the other, and it's going to create issues. So yeah, this should all be behind the scenes solution that is not the concern of the end investor.
I would tend to agree with that. I think there will be an abstraction layer that people don't really know or care at which chain that is. Also, interestingly, when you look at the top chains at the moment, really a few of them capture majority of the volumes, and then there is a long tail. You mentioned the word zombies, maybe not all of them, but really long tail of very low volume, low activity chains, which obviously going to be less relevant than the top few.
Going to fade into irrelevance, pushed out by the market. Yeah, that's the evolution, law of evolution. So we have a couple of more very interesting questions regarding Ondo. So there's a question from Joseph. He said that Ondo's TVL and adoption is increasing, but the token doesn't reflect that growth. Why the apparent gap?
Yeah, I get a lot of questions about the performance of the Ondo token.
Yeah.
Unfortunately, that one I can't answer because the Ondo token is managed by the Ondo Foundation.
Okay.
Ondo Finance is the entity behind the tokenized treasuries and the stocks and ETFs, so it's completely separate. And the business that's under Ondo Finance has no bearing or impact in the Ondo token price.
All right. Yeah, sharp and clean. So yeah, there is a huge mismatch between token prices and fundamental value that different platforms are bringing. So it's not something that is very weird in the space. There is a question from Thomas. So concerning voting rights and for tokenized equities, Ondo just announced a partnership with Broadridge. Is that voting process already available, and how were those voting rights considered before?
Yeah, so the partnership we announced with Broadridge is something that's really commonly done in traditional finance. I personally don't think this was a big issue for retail, but in traditional finance, companies like Broadridge are very widely used to enable proxy voting to the end investors. For example, if you were a hedge fund trading on total return swaps, you don't have beneficial ownership to the underlying, similar to tokenized equities. But now with proxy voting, you can submit and participate in any sort of agendas or board meetings.
Yeah, noted. There is also one very interesting question for both of you, and with that one, I would conclude our discussion. So feel free to elaborate a little more on it. Speaking of costs, what kind of gaps do we have between TradFi and DeFi for a full trade? For example, like execution, settlement, custody. So Marek, you can start.
Yeah, I mean, by definition, if you remove a couple of stages from the full trade cycle, like clearing, the transaction should end up cheaper, and also if you remove, because you remove the risk, right?
Yeah.
Which costs the behind the scenes, it costs the whole market quite a bit of money. Then also, if you consider the smart contract automation, that would remove a lot of often manual work or semi-automated work on the post-trade side of things. That again is something that that should lower the cost of operation. And then if you consider with a quicker capital turnover because of the atomic settlement, again, this is something that should be beneficial. How quickly? The question is whether that's going to be cheaper overall versus the legacy infrastructure. It's a matter of adoption. So the moment we see the real comparable, or sizable volumes, material volumes on chain for equities and other similar types of assets, then the cost of the infrastructure, the new infrastructure, will definitely be cheaper to run in the longer term. Now, the tricky part is the transition, because of the legacy infrastructure is being operated. In some cases, it seems quite efficient, even if it within its limits. So the for the institutions to make the investment and for infrastructure players to make an investment to make the changeover, it's obviously it's a bit of a barrier that I think sooner or later we will, and in general the cost of doing business should go down.
Yeah, less elements, which will lead essentially to lesser costs. Yeah, business logic. Oh yeah, do you have to add something?
No, I really agree. I think as the market becomes more mature and more efficient, its costs tend to find its place and be minimal over time. Like if you look at crypto custodians, for example, charging for custody in a traditional prime brokerage is not a thing. They make money off of other things. But crypto custody, people were charging quite a lot for, and now that's come down quite a bit as that's been solved for. So I think we're going to see the similar thing in terms of the trade flow.
Perfect. Thank you so guys for this discussion. Thank you for jumping on all questions that our beloved audience had to ask. And yeah, it was very valuable. One, I learned a lot, and yeah, thank you for returning the call and joining me, and especially thanks to you, Oya, for being the first woman on Future of Finance. So it's a big milestone.
My goal in life.
Congrats. Yeah, thank you guys. Thank you, Marek.
Thank
you. Catch you in Zurich. Yeah. Bye.
Bye,
guys.